So, hello everyone, welcome back to your channel. Well, today you are going to learn. You must have seen many times people ask to give some tips for stock selection. Which stock is going to rise? If we come to know first, then we will invest all the money in it and we will get more profit. But you will see that such people mostly suffer losses because they believe in someone else analysis. They believe that another person will give them a magic tip and they will double triple the money. Well, money double triple in the stock market, but how it happens, why it happens, it is more important to understand the logic behind it. So today I am going to simplify stock market investing. First thing first, you will not need to take recommendation from anyone after this video. Will you be able to analyze a good stock yourself? Suppose any of your friends suggested to you that the share of such and such company are worth rupees 1000. You buy immediately, it will go from 1000 to 2000. Now you will know that I am buying a share of rupees 1000. Should I buy or not buy this? This stock is not getting expensive. What is the company earning? What work does the company do? Where does the company stand? How much money the company has? You will be able to do all the analysis by yourself only after this video. So this video might be a little long because I am going to clear a lot of concept for you in this video. So you must have heard many times about different financial ratios. When we talk about current ratio, valuation ratio, PB ratio, PE ratio, debt to equity and balance sheet of the company, we talk about it. There are some ratio we don't hear about. I will also tell you the interest coverage ratio. Why it is important, I will tell you. And you must listen about ROE and ROC, return on equity and return on capital employed. But you know CFM and NPM. I'll tell you, NPM means net profit margin and CFM means cash flow margin. But why I am telling you this here? This means that I want to simplify your stock investing. So today if you have learned this financial ratio by spending a little time, then the first thing is that no one will be able to make you mad. And if you get a recommendation from somewhere, then you will be first analyze yourself and then go and invest, and you will learn to filter the best stocks. Now let's start the video. Why I am talking about financial ratio? Because we hear a lot but understand very little. So here I will tell the current ratio formula, how to extract PE ratio, how to see PB ratio. So here you will not understand anything at all. That's why I want to tell you in very easy language so that you can understand everything. What do I want to convey and what do you understand? And if you think I will not tell the formula, if I tell you in easy language, how will you understand? So let me tell you that here you do not have to give any exam. Only you have to understand this thing for your understanding. So if you want to filter the best stock, then first of all check its fundamental, and you have to look PE ratio, PB ratio and debt to equity. So here you have to understand simple things. I will not confuse you by saying ratios. Here you just have to understand the basic things. So some things are highly important to check. If the PE ratio of company is showing 5 or 10 in fundamental analysis, it simply means that you are giving 10 rupees to the company to earn 1 rupees if its PE ratio is 10. And if the company PE ratio is 5, then you are paying rupees 5 to earn 1 rupees. And if the market thinks that the price of the company will increase in the coming time, then it will give more PE ratio to the company. Like it simply means that if you are selecting the stock of a company for investing, then the lower its PE ratio, the better it's for you. Now PB ratio, price to book value ratio, it's similar to PE ratio. PB ratio means its PB ratio is lower of the company, the better it's considered for the company and good for stock investing. And if the company's PB ratio is 1 or 2, it's good for the company. Now coming to debt to equity, means how much loan has the company taken in lieu of equity. It means to say that if the debt to equity ratio of a company is 1 or 2 or 5, then the company has raised 5 times the debt in lieu of the equity. And if the debt to equity ratio of company is 2, it means that it has taken double loan. Then it simply means that the lower the debt to equity ratio, the better the company is for selecting stock and investing. Now what to look for in the selection of any stock to invest? PE ratio of any company should be low, PV ratio should low, debt to equity ratio should low, then it is the best stock to invest. Now to increase your accuracy, I add one more ratio called current ratio. Current ratio means what the company has today. What will we get even if we have to sell the company today? And tell you how to check current ratio in easy language. Then the company which has high current ratio is the best stock for investing. It means that how much money does the company have today with how much money is the company sitting in the market. And if you want to filter the best stocks in a better way, then you have to read the balance sheet of the company, and you have to see what is the market cap of the company and how much cash flow. I hope you have liked the video and you have got very good information to filter the best stocks